The shares look fantastic value. So the question is it a value trap? Is the value so cheap for good reason? Is there a very valid reason that the shares are cheap and they will remain permanently cheap? Or is it a terrific bargain? The shares have ticked up a lot lately, but this business has some issues.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello. Good to be here as always. Another busy week.
Yeah, it certainly is. And with another jam-packed episode as well, covering a potential value trap, potentially two recovery stories that we're going to discuss, a stonking small cap, and of course various other stocks covered as well. But first of all, we're going to start off with international news, starting off with Bitcoin, which has been a little bit crazy lately, to say the least.
Been all over the place lately because of Hong Kong announced approval of its first spot Bitcoin and Ether exchange traded fund. These are going to be funds traded on the stock market that actually invest in Bitcoin. And apparently the big thing coming up is shortly, in a couple of days from when we're speaking, is this Bitcoin halving event. This happens every 4 years when Bitcoin miners, the miner reward is cut in half from 6.25 Bitcoin to 3.125 Bitcoin. And everybody's saying that this halving event traditionally subsequently results in a huge spike in the Bitcoin price. I don't know on what basis this price moves around. It's just beyond me. It's just total gambling and speculation or nothing. It's just ludicrous from my perspective, but you look out for a huge spike in the Bitcoin price over the next 12 months. That's what everybody's saying.
Yeah. And just to be clear, we're not saying don't buy Bitcoin, far from it, because as we discussed earlier, we're not quite sure what the intrinsic value is of Bitcoin, are we? So
I'm clueless. I just don't get it. It's just wonderful for the punters, though. And I'm sure some people have made heaps of money on it. But yeah, look out. It's a real roller coaster.
Yeah. I'm sure we're too old, Chris, to understand that's probably what it is.
Yeah. Good thing too. Good thing too.
Moving on then. So what about Blackrock as well? Unbelievable. Just hit 10.5 trillion AUM.
Yeah, assets under management. Blackrock, the world's biggest asset manager. If you're listening to this, and you have a pension, your pension is likely to include funds Blackrock. You have money with Blackrock. It's touching all of our lives. It's these asset managers, these specialists that invest that run passive funds. This isn't run by manager. This is just a machine generally following the stock market index, and BlackRock is huge in this, or an index of some kind. They're collecting huge sums of money. And BlackRock is another fund management group that's benefited from Bitcoin because it has launched some exchange-traded funds that you can buy and sell on the stock market, and they've already grown to 18.7 billion of assets under management, just the Bitcoin funds. It's winning from Bitcoin.
What do you think, Chris, about having that sort of assets under management? What's your thoughts on that?
Well, it becomes quite a responsibility, and it's scary, I think. So much money now is really concentrated in the hands of these giant fund managers. You've got Vanguard as well, which is another passive investing specialist. It manages trillions as well. So yeah, I think it's slightly worrying. And everybody's sucked into following indices. And the indices currently, the index and the US index, for example, is just dominated by relatively few large companies. The Magnificent Seven were the big drivers of returns previously. And you just got, it's all polarized in relatively small stocks, which I don't think's great, but I'm not sure of the way out of it currently.
Yeah, I am far from one that would ever say nationalization. But we talk about nationalising the trains, electric, water, etc., etc. Could passive investing just not be nationalised and regulated by the government, just as Nest pensions are?
Yeah, good point. Good point. I mean, and Nest pension seems to be doing very well. Yeah. Conceivably, they're likely an angle for that. The fund management industry won't like it because they earn very rich. They earn very rich fees on doing increasingly very little.
Very little.
When you're just following an index. If you're an active manager, like I am, management, a stock picker, the general focus on smaller companies, you do add value, I think, but not if you're looking for exposure to the index and big companies. It's pretty easy nowadays. You just buy an index fund and shut your eyes.
Yeah. You mentioned the Magnificent Seven there as well, which transitions quite nicely because there is a company that's now fallen out of Magnificent Seven and they're laying off 14,000 workers, aren't they?
Yeah, that's Tesla. Tesla's 10% of its workforce, quite substantial. Tesla's been a real pin-up. It's been a great success story, amazing business, how this has grown to such a scale. But its valuation, the shares have now fallen 37% year to date, and that's quite substantial. It was a real sort of, it's a well-followed stock and well-loved by investors, and it's sucked in a lot of interest. But yeah, its value, look, it's still just shy of $500 billion value company, which is staggering. That's 7 times larger than Volkswagen Group. And it has a third of the revenue of Volkswagen Group and about 75% of the profit. So it's still massively valued, huge presence, but its shares have been dropping. And you can't really say it's the Magnificent Seven now, given the continuing performance of some of the other constituents of that group. We'll see who else falls out. As we were chatting, the Magnificence ended up, and Seven on film ended up as only 2 or 3. Maybe that's where we're going to go.
Yeah. Speaking of the continent as well, third largest company, ASML. How many people do you think have heard of this company, Chris?
That's what I thought it would be worth mentioning, just briefly. This is the third largest company in Europe, and it is a company that few people have heard of. So the largest is Novo Nordisk, I think second is Louis Vuitton Moët Hennessy, and ASML is the third largest, and it's a company, it's a Dutch company. Years ago, it was spun off from Philips, and it's now about multiples bigger than Philips. It was a long time ago, and it's a producer of semiconductor manufacturing equipment. So all these companies that need the chip makers, the equipment needed to make the chips, ASML is the key provider, and it outsources a lot of the tools and effectively assembles them. It's got a huge sort of order book. It's growing like mad. Clearly, there's huge demand for its machines. It's just an amazing business, amazing story. Look at the share price. It's done so well over the last few years, up 50% over the last 12 months. So yeah, ASML, worth having a look at because it's touching all of us as well. It's another business you've never heard of, but it touches all of our lives.
Yeah. You mentioned there Louis Vuitton as well. Did you say Louis Vuitton was the
Yeah.
second biggest company? They've just announced to have weakest quarterly sales for quite some time.
Yeah, yeah, they
And
have.
what's your thoughts on that one, Chris?
I just think it's a great business, very well run. It's harnessed lots of fabulous legacy brands that it's continues to elevate. I think it's a real lesson in brand development, brand ownership, and across multiple brands, across multiple sectors. It does really well out of leather goods, but it also has huge presence in wine and spirits, champagne, watches, luxury watches. Yeah, I mean, it hasn't been doing as well, but it's still growing. Sales growth was 3%, so it's still growing, and that's on the back of have absolutely banner growth in particularly in the Far East markets, China as well as a key growth market. And China fell off, whereas some of its other markets were still growing strongly. The wines and spirits bit was the weakest performer, with like-for-like sales fell quite materially there. But some of its other areas still grew. But I think it's just a fantastic example of a brand curation and development and done very carefully. It even has a big hotel business, Belmont Hotels, luxury hotels. It's got some really niche offerings as well. We like it. I think it's a great business to own as well, and a standout in its sector. Other than Hermes, its rival on the French stock market, which is a lot smaller, but rated even more highly than LVMH.
Yeah, they do actually seem to do really quite well, the French, don't they? With L'Oreal as well. It's another one,
Oh,
isn't it?
fabulous business. Another one of our, ultimate stocks portfolio. That's a brilliant business as well. The sort of returns they generate and the returns of capital employed as well. I would urge people to look at them. If you're looking to try and look good companies, good growing companies that have grown through organically, plus through acquisitions, it's worth looking at LVMH, L'Oreal, and Hermes even as a company that's still dominated by the family. And family ownership in Hermes has really did it and kept it very relevant.
Should we move a bit closer to home then? Should we look at some of the companies on the UK mid-cap?
Yeah, I thought one business that's worth mentioning, EasyJet, seems to be doing pretty well. Contrary to what people thought, there might be a slowdown, consumer pressures, slowdown in people wanting to travel, but the thing they seem to want to do is travel, which is good despite problems in Israel as well. The EasyJet's still flying quite literally, flying a lot of people. No pun intended. And unlike its two big rivals, that's Ryanair and Wizz Air, its low-cost rivals, low-cost flight-only rivals, EasyJet hasn't been hit by the Boeing problem. It's been buying its planes from Airbus, much like our favored stock in this sector, Jet2. Jet2, our associated business fundamental, owns on the portfolios. I think Jet2 is a great company. It's all about its holidays, not just flights. But Jet2, much like EasyJet, has been buying Airbus and not Boeing's, which have clearly had quite a few problems. But yeah, EasyJet, keep an eye on it. It seems to be holding up well.
How important is brand, Chris? Because many private investors, they talk about brand and that it has value. And EasyJet, everyone recognises EasyJet, Jet2, recognisable brands. And we've just been talking about LVMH, the brand recognition that Louis Vuitton has, and the ability that that company has to charge a premium for that brand. But then if we contrast that with, let's say, Superdry here in the UK, Doc Martens, their brand has fallen a little of late, hasn't it?
Yeah, I think it's interesting in how the key things, how do you keep brands relevant and in vogue? It's so difficult. Superdry was booming a few years ago. Everybody loved it. Then you have the risk of overexpansion and it becomes less, everybody's got it. It's not different. People don't want it. It's not fashionable. But you then suddenly got shops all around the country in the most expensive, some of the most expensive streets and destinations, and with long leases that you're stuck with. And it's just a horrible scenario of overexpansion and overproduction, perhaps of a brand that's no longer of interest. And Doc Martens is another one. It listed on the stock market. I think this is another bonkers story. And it listed in 2021 at 3.7 billion valuation. I didn't look at the company then. I looked at it. Its valuation has declined from 3.7 billion to just 644 million pounds currently. So huge decline. Doc Martens. How can a company with its product lineup and brands that have had a significant roller coaster ride over a number of years have ever been worth that much? It's another classic of a private equity dump on the stock market at peak value. The private equity owners of this firm, who bought it in 2014 for 380 million euros, they cashed into the tune of 1.3 billion at the peak of the market, and they've swanned off. Always be wary of a private equity listing on exit on the stock market. Thankfully, we haven't had many lately, although we do need more listings, but of the right kind at the right valuation. It's a tricky one.
Are we going through a period as well, we are at the moment, where private equity are buying up lots of UK companies?
Yeah, we are, yeah. They're buying them really cheaply when they're doing fine.
Yeah.
They'll probably load up the structures that they buy them through with debt. In a few years' time, they will have to get rid of them again because their shareholders want an exit, and they'll lob them back on the stock market probably at the top of the cycle.
Just like Doc Martens here.
A bit like Doc Martens. At top of the cycle, and the institutional fund managers who bought into stories like Doc Martens will probably have forgotten about things by then and be buying another company at the top of the cycle. It's just, it frustrates me because it's just valuation nonsense. But you're right, that's what's going to happen.
Yeah, history
Sure
repeats. History repeats. And then moving on to another company that you've actually visited the management, haven't you? Chapel Down Wines.
I just think it's a really interesting business. English wine is booming at the moment. We've got so many new wineries, new plantings, some in the south of England, Kent, Sussex. It's just been a great space. Chapel Down seems to be doing well. It's one of two listed companies, AIM, English wine companies on AIM. The other one's called Gusbourne. Chapel Down arrived on AIM in end of 2023. It just came out with results, 15% growth in revenue to 17 million. And it's been making most of its money from its sparkling wine, which is made in the champagne, uses the champagne method traditionnel for making the sparkling wine. And it's also, its rosé has been booming, and it makes most of its money from that, most of its margin from these higher priced sparkling wines, circa 30, 35 pounds. And they go much higher to their special cuvées as well. They're about 60 quid, I think, resale price. But it also makes still wine, which is around the £15 mark, which is still relative, I think, to the wine compared with what's out there. It's less of a differentiator. Look, I'm not an expert in this sector, but going back to LVMH, Moët Chandon is the champagne is at the heart of LVMH's business. Hennessy Cognac as well. It's on at that premium end. And I just wondered if Chapel Down's future resides really very much at the premium end. So forget about the still stuff. It's also doing well. It's incredibly complicated business. Winemaking encompasses, you're a farmer, you've got to be involved in the production process. You're a brand specialist as well, a retail specialist. You're a tour guide because it has tours of its vineyards as well. And you've got to be very long term because you plant new vines, they're only going to start producing in 3 to 5 years. Then you've got to wait for the things in the bottles to mature as well and ferment and produce the whatever, the champagne, the gas. And the more expensive ones last even longer. So it is an incredibly complicated business, and it encompasses every aspect of business. But I do wonder if the future of very much of English wines is only at the premium end. I question why it's worth bothering at the lower end where they're less really relevant and they won't make desired return on capital.
Was there any sort of feedback when you had that conversation with them, sticking at the premium end? Was there any sort of feedback on their kind of long-term view?
Yeah, I mentioned the fact why I asked why they're in the still wine area because it's only 20% of their revenue at the moment. It's a pinprick, and well, not a pinprick, but it's a small element. They did explain that the method of production pressing means it is actually quite efficient for them to use some of their white wine pressings to put it into white grape pressings, put it into white wine production because they're not necessarily suitable or less suitable for sparkling wine. So there is some logic to that. I'm not aware if you do a comparison with the champagne producers, if they do the same thing. And the champagne producers seem to have got together a pretty good business model over the last 100, 200 years, or however long they've been going. But yeah, I like the tourist bit as well. I like the tour bit. That's a high margin, but clearly that's a capacity constraint. They can, I think they had 60,000 people go around their vineyard and winery last year, which is pretty good.
Wow.
But I don't suppose they're going to have many more than that. But the other thing about this business, a question I asked as well, is it's very hard to value. If you look at the numbers they're producing at the moment, and even the profits that they're likely to produce in 2 or 3 years, it's hard for them to justify the current 110 million valuation on the stock market. But maybe 10 years out, it might look cheap. By the way, they have good shareholder offers as well. So I think you get a decent discount if you're a shareholder. You haven't got to buy many shares either. So those people who are interested in this business, you can buy a few shares and also benefit from a discount on their products, which can't be bad.
Not to prolong this conversation, but I guess maybe Fever Tree Tonic could be an example of staying in that premium end of tonics.
Good point. Really good point. That's a good example. Another AIM company as well.
Another AIM
Good
company,
point.
yeah. It's, they stayed in that premium end, didn't they? And look how well they've done and continue to do as well. So
yeah, the key difference is they have greater control of their production. Poor old Chapeldown is at the mercy of the starting, at the mercy of the weather.
Yeah.
Oh, what a nightmare. What a nightmare business. So when you have a nightmare business, it's best to make margins on it and stick to super premium because you've got so much trouble going on in the middle that it's only worth it if you have such big margins.
Yeah. Should we move on to a company that perhaps is a little bit more in control of its revenue? Ashtead Technologies.
Yeah, this is very briefly. This one's booming. It's a provider of subsea equipment rents equipment for the people operating offshore, oil and gas, plus the renewables. Growing number of wind farms out there off the coast of Britain. More and more tools needed to support them. So Ashtead has been absolutely flying. It's been doing really well. And they think their market's getting bigger as well. So it's really one to look out for. However, the key takeaway on this one is be careful when the cycle turns. Oil and gas, they can turn very, very quickly. But Ashtead's doing great, and conceivably, it looks like that's going to continue for a few years to come. But yeah, it's been a great success story on AIM.
Worth a second look. Look.
Definitely.
So the next company we're going to discuss is Renold. And this is a company that is potentially a value trap. So Chris, would you mind explaining what is a value trap? And what are the red flags that you look out for that may indicate that this company is a value trap?
Renold's a supplier of industrial chains and power transmission. Chains are used everywhere. We're not talking about bog standard link chains that go on a fence. We're talking about the sort of more extension of bicycle chains. But they don't do. They do bicycles, but very high end ones. But chains used in industrial equipment, power transmission, was set up way back in 1879, and the shares look very cheap. It's got a few issues in it, and we'll expand on that. But the shares look so cheap that they look amazing value. The shares look fantastic value. So the question is it a value trap? Is the value so cheap for good reason? Is there a very valid reason that the shares are cheap and they will remain permanently cheap? Or is it a terrific bargain? The answer to this, the shares have ticked up a lot lately, But this business has some issues. And the obvious issue you see is that it's got a pension deficit. So it's got a big drag on it. It's this huge pension for a business that's turning over £244 million a year, which is sizable. That's a lot of revenue. It's only worth about, the market capitalization is only 95 million, but it's got a deficit. Its pension fund is about I think just shy of 300 million quid. And it's got a big deficit of about 50 million quid attached to that pension. That pension sucks in a lot of cash. Effectively, whatever the business produces and makes in profits and cash, a lot of it's being used, channeled back into supporting former workers, retired workers and their pensions. It's not being used to fund the future of the company. It's supporting the past, which isn't a great scenario. However, that is known. My own view is that the CEO is perhaps overpaid relative to the business that he is running. A salary of 1.2 million per annum is quite a lot for a relatively small company worth only 95 million quid that has struggled to advance over the last 5 years. But that's not my issue, my concern with this business, and we've looked at it a bit, and I say it probably wrong, but my main concern is it's not growing at all. The top line is been declining. It's made some acquisitions, and if you exclude the acquisitions, there doesn't seem to be any top line growth. Really, you probably wouldn't expect that in a 150-year-old plus manufacturer of chains. This is not a business. This is just a global GDP plus business at its best. That's probably only in the specialist area, but a business without any top line growth that hasn't demonstrated that for a while, from our perspective, is potentially a value trap. That is the main concern. There's got to be some resumption of organic growth at some point, and this business is clearly struggling on that front. This business hasn't delivered a huge amount, very little to shareholders, yet management seems to have been paid quite well. It may be a little bit harsh, but paid pretty well for just the journey and not the arrival. I think people should be overly rewarded for really hitting the heights, hitting demanding targets that have benefited all stakeholders, notably shareholders.
Should we move on then to Everyman Media, encouraging results?
Yeah, it's encouraging. This business's the shares have been absolutely smashed. And Everyman Media is a cinema group, and it very much focuses on premium offering. A lot of focus on the food and beverage. It makes as much money on the food and beverage side as it does on the cinema tickets themselves. But it's now become apparently the fourth largest cinema chain in the UK by number of venues. But the shares have been pretty horrid. In normal, a cinema group should be really cash generative. You think about it, you open your cinema, spend a lot of money kitting it out. You've got at least the building probably, or you might have bought it. But thereafter, it should pour in cash. This business is generating cash, but it's using all of its cash to acquire new sites, refit the new sites. And to my mind, it really hasn't demonstrated at the lower level that it can really work. Clearly, it had the pandemic, which smashed everything out of the ballpark, and it was struggled to make just survive. But since then, post-pandemic, it's now jumped back onto the acquisition mill, and it's buying more and more, acquiring more and more sites, leaseholds typically, and investing in them. It's a little bit worrying because while its debt is under control, if you keep leasing more and more of these sites in new locations, your lease liabilities start rising. And it's got lease commitments now of £107 million. And that's quite significant. And it's a business, much like the Chapel Down, which has loads of variables. Clearly, the weather can impact its activities, but principally, in any single year, it needs a decent roster of new films. Without those, well, it's going to struggle to attract viewers, isn't it? And it's also open to the streaming services. So, yeah, we'd like it to slow down a bit and probably start generating some proper free cash and to start returning that to shareholders. And I think it might get a better hearing on the stock market if it starts doing that, rather than opening more and more sites, many of which might be suboptimal, shall we say, and not deliver the desired returns.
Yeah. I like the idea. It's essentially a restaurant that shows movies. So
Yeah, it's a good concept.
I like the idea, but as you quite rightly say, like Chapel Down is dependent on the weather. Everyman Media is dependent on Hollywood producing decent movies. And subjective opinion, one may say they've not been the best quality for a few years now.
That's the problem. But they've continued to, as I say, the opening spree. And I think the lease liabilities are starting to look quite scary for a business where the cash flow is not that certain. It should
Yeah.
be certain, but it's not that certain because you've got the movie dependence, how good or how bad they are.
So I've just got a chart here. Number of movies released in the United States and Canada. 2016, 2017, they released approximately 750 to 800 movies. And then obviously the pandemic was a big problem. But at the moment, at 2020, 2022 to 2023, they released 449, roughly just more than half the movies
Yeah, we've
pre-pandemic.
had strikes as well. We've had Hollywood
We've had the
strikes as well,
strikes.
haven't we? We had the writers' strikes. Again, that's another. It's terrible having a fixed asset that's cost you a sort of fixed that's cost you a lot of money to set up, and then you're still dependent on so many unknowns coming to fruition and working every year consistently, year in, year out. So it's quite a tough business.
Should we move on to two companies that have been not ideal performers of late? Are they ready to bounce? What do you think? Team17 Group?
Yeah, we got two of these, Team17 and INSPECS. Team17 is one of AIM's video game developers. Its fellow developer actually did another one called Devolver Digital announced also results recently. Team17 has actually been one of the better performers. It doesn't just make games, it does edutainment as well. That's educational games. It does simulation games. It's bought into these areas. But yeah, look, the shares have been waxed. They're well off highs, the pandemic highs, the lockdown highs when everybody was playing games and we thought it a wonderful area. But video gaming itself, it's another boom and bust. You've got to put loads of money into developing a new game in the hope that it's going to be a success. The other thing that I'm getting wiser to is a lot of them, and Team17 is one that makes a lot of this, they make a lot of their back catalogue because they say, oh, we're making, I think Team17 works 70% of its revenue off its back catalogue. Whilst they don't give details, the more I look into it, I think this back catalogue still demands quite a lot of support. So it still demands a lot of expenditure. While all the initial development costs have gone, I think these things still need ongoing development to stay relevant. And I think that's the risk and the unknowns. Yes, you can witter on about the back catalog, and Devolver Digital made 83% of its revenues from back catalog. But the back catalog still needs support. Like any software, you still need to keep plowing money in to keep it updated. And that costs a lot of cash, which is a little bit of an unknown. But I think Team17, I think it's one of the better ones. We hold the shares in our fundamental AIM portfolios. I think they could be a good recovery story. It's still got a lot of cash, so it's got a lot of cash to support it. And revenues did grow, so it is growing. It's just that cost base needed addressing, which I think it's done. The other really big disappointer is a group called INSPECS, which has been a bit of a disaster since it listed. The shares have fallen more than 70% from its IPO price in February 2020. It's a maker of eyewear, both lenses, frames. It's vertically integrated now. It's opened a new factory out in Vietnam. It manufactures, I think, in Italy as well. But yeah, it's been a disaster. I struggle to understand how a relatively new business with revenues of over £200 million can't make any money. When it joined AIM, of course, like so many IPOs, it was making attractive sort of 15% margins. Now it can barely squeeze any margin. But surely a business with 200 million of revenues in a growing sector like eyewear, I know there is a dominant player in this space, but it's a real giant, but surely it can make a circa 5-10% return consistently. Probably a 10% margin isn't unreasonable. The valuation, going back to value, looks cheap. Is this another value trap example, a sort of 9 times multiple? It's got a bit of debt. Seemingly they've started to tidy things up, the management. The manufacturing, they seem to be getting to grips with that. And hopefully they could be a good recovery story here. But yeah, it's been a pretty awful performance so far.
Or a value trap.
Or a value trap.
Time
We
will
don't
tell.
know. Time will tell. But yeah, come on. 200 million revenue. Surely you can get a profit out of that. Slim it down to half that and make money. But
Yeah.
there must be something there. You're selling things. People like them. You're generating cash. There must be some value there.
Yeah, they're doing the hard part. They're making sales. They've just got to
Yeah, I know.
eke out
I
a profit
know.
in them now.
Absolutely. And also, I'd like management to explain the relevance of their innovative water-soluble bag for an eyewear company. That's a mystery to us at the moment. What that relevance their water-soluble bag has to an eyewear business. But yeah, we will hopefully get an answer to that soon.
Yeah, time will tell. Should we finish off with a stonking small cap, Keystone Law?
Yeah, I think this is great. This is a terrific business, really good business. It's a legal firm, a challenger legal firm, but it's not really a legal firm. Don't look at it as that. It is a platform. It provides the central service platform and compliance and regulatory platform that lawyers can effectively link into. So all its lawyers and fee earners are all self-employed, and Keystone takes care of all their administrative, the onerous administrative bit, and takes a margin off it. So it's low risk. It only has to pay the lawyers as well for their fees once it receives the money. So it's really cash generative. And a lot of lawyers like the flexibility of this structure. So they move out of their big firm with the pressures that come with a big firm and sort of partnership structure. And they like the fact of joining as this kind of network as a self-employed lawyer. And it's really good. Margins are fabulous. Cash flow's great. It's given out 2 special dividends. The shares aren't cheap in terms of valuation, in terms of PE multiples, but the return on equity is great as well. As I said, cash flow is very good. So I would implore people to look at Keystone Law, but it's unlike any other legal firm on AIM. This is not a traditional law firm. It's very much a platform business, a lower risk platform business as such.
Brilliant. Should we leave it there?
Yeah, I think some interesting companies there. We're invested in them whether we like it or not.
Brilliant as always.
Yeah, look forward to it next week.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.